All right, good morning, everybody. Well, welcome to the first speaker series event of 2019. Very, very excited to be here. This is an event that Guaranty Escrow conducts every month. We're trying to actually add a second date every month so that we have one down here in the Torrance area and also in the beach cities. And I think that's, assuming our panels are willing to take their show on the road, that's always interesting. So I'm glad you're here. We have several events planned for the future. We have a February speaker series. You'll be getting emails and invitation. We have an IRS agent and a franchise tax board agent. I think it'll be a really interesting dialogue, partly from real estate and escrow, the requirements of withholding and the responsibility that we have to the government to do the proper withholdings. And I think it's an interesting point for realtors to understand a little more about that process. It's a bit mysterious. They're also going to be talking about tax returns and financial nuggets to share with independent contractors and realtors. So that should be an interesting talk. I think we have Stephen Garcia, who is an attorney who specializes in negotiating, not for hostages, I don't think, but he's a good negotiator. And he is going to be here in April, and I think that's going to be real lively and fun. And then he's March, and then April we have Carol Kwan from the Assessor's Office. I think many of you may have seen her. She's a very popular speaker, and there's a lot of great information that is gleaned from talking to the actual assessor about how they can undo a problem or give advice on questions regarding transfers, interfamily transfers, parent-to-child transfers, all that. So we have a really good series coming up, and we will keep you informed of all those events. So today we have assembled a panel that I am so excited about. Aaron Anvarapur, did I do that right? I practiced.
You got it.
Is with Redondo Mortgage. He is a mortgage broker in Redondo Beach, and Aaron has been in the South Bay area his entire life, a graduate of Miracosta High School. He graduated from UCLA with a BA in economics in 2004. Aaron's been a multiple-time recipient of the 5-Star Professional Award, a recognition for unparalleled customer service and client satisfaction. He possesses the ability to simplify the loan process and develop customized solutions for clients, regardless of challenges, right? So Aaron is representing that mortgage broker person on the panel, right? Can kind of be nimble in the middle, and many of these folks can handle, there's a little crossover between them, but each represents a unique strength in the finance community, and if you have the cards of all three of these folks, you're well equipped. All right, Sheila Azadi, I apologize. Sheila is a senior loan officer at Bank of America, located in the Palos Verdes Financial Center in Rolling Hills Estates. She has more than 19 years experience in the mortgage industry, and she is a top producer who has earned Chairman and Pinnacle Club status, which means she is in the top 1% nationally, which is quite impressive. Big Bank, Bank of America. All right, and Owner Koskin, who is a new friend of mine. We served on a panel middle of last year and became instant friends, so I'm really grateful that you took the time to be here. Owner is with South Bay Equity, and he is a mortgage loan originator of 12 years, is regarded by real estate professionals, industry contacts, and clients as an expert when it comes to creative lending solutions. Back in 2013, he saw an opportunity in non-QM, we'll talk about what QM is here shortly, lending, the world of financing that occupies the space outside of traditional financing, but not hard money, and decided to dedicate himself to what at the time was a burgeoning market. Since then, he has a track record of success. He's made a name for himself as a top operator with non-QM mortgages, being the fastest growing segment in lending by far. He's he's excited more than, I'm sorry. He's excited more than ever. I should be wearing these to be able to help many people in their financing needs for 2019 and beyond. So thank you, owner. Thank you. So, you know, with real estate finance, there are so many areas that are, I think, mysterious. We're real estate professionals. We understand what it means to go obtain real estate financing, loan applications, appraisals, all of that, and we can talk a bit about it. But I really would like to kind of ask some just the overarching questions of the entire panel, and they'll speak to it. And then we'll have some specifics in their particular segment of the finance market. So I think my first question, and one that I hear frequently, especially when we have the Federal Reserve kind of getting involved in interest rate adjustments, what are your thoughts about interest rates in 2019? Do you have any forecasting, prediction, good guesses? What are your thoughts, any of you?
Ladies first.
Okay, thank you. You know, based on everything that we read and the forecast with, you know, real estate, car, and all the other things that we've heard, basically rates are going to go up. You know, it's between where it's going to be in 2019 and 2020. It's going to be around 4.8 to 5.3, somewhere in that arena. And in terms of the real estate market, the forecast is that it's going to be declining about minus 3.3. So not really a lot. So rates right now, though, they're still very, very low. You know, we're still doing 30 years jumbo at 3.875. So, you know, it's just the market thinks that, oh my God, rates are up, and, you know, they're kind of sitting on the sideline. So I think, you know, we're still in a great, great market. And because the economy is doing so well, and, you know, people are going to earn more money. So therefore, the affordability is higher. So real estate is still going to be pretty strong because, you know, people think, okay, rates are going to go up, so then housing is going to go down. And that's not really exactly what is going to be happening. So I think, you know, that's where, you know, we're looking at. We have to just educate our buyers, you know, that, okay, if the rates do go up a little bit, you know, how much affordability are you going to, it's not just about the rate, but how much less can you buy? So that's really what we need to be looking at. But historically, I mean, we're still in a pretty good market, and we need to just get the buyers going. And I think inventory is probably one of the key issues here. So as we have more inventory coming in, I think we'll see the market picking up again.
Yeah, yeah. You guys are both nodding. It sounds like you agree.
Yeah, I mean, there's some technical consensus out there since the Fed stopped purchasing mortgage-backed securities back in 2017. I mean, the consensus was that rates would naturally go up because they've been artificially kept so low for so long. But at the same time, I mean, I've said that for the past 12 years that I've been in the business, and I've been wrong every year except last year. So we'll have to see if 2019 continues the trend, but as she alluded to, I mean, it's still historically low rates, and to be frankly honest, I mean, I haven't seen that affect my business as much as the perception might be out there.
I think if I can add, I think right now is a really excellent time to buy because it seems that rates are lower than they've been in the last 6 months. Right now, as Sheila mentioned,
They're lower?
Yes, they're lower, and the market and the general public doesn't know that quite yet. I don't think everyone thinks that rates are so high because of all the publicity. The Fed, you know, when we talk about rates, there's different rates. But everyone has in their mind that all the rates are the same. So the Fed controls federal funds rate, but then there's also the mortgage rates that are controlled by, as owner said, mortgage-backed securities. Yeah. So what we saw recently was the Fed has raised rates, and then it softened the financial markets. Money is going into mortgage-backed securities, and that's lowered the 30, the long-term rates. Yeah.
And it's interesting too, because I think, if I recall, there are conforming loans and jumbo loans, right? And I think there was a conforming loan limit adjustment recently. Maybe you could speak to that. But aren't the conforming loan rates lower typically than jumbo rates? Is that not the case? Because it seems like I see conflicting information about that.
Typically, conforming rates are lower, and it may be for some lenders lower than other lenders. We at B of A, we actually put anything over the conforming loan amount, which is now I think 484,000 and change. We actually put those loans as long as the clients match the guideline of a non-conforming, the jumbo loan. We actually put them in our jumbo loan program because we have better rates for our jumbo products than we do our conforming.
So you can do that. You can give them the jumbo rate if it's better.
If they
than
qualify for the jumbo product, the reserves, the DTI, and all of the other things, if they qualify with the guideline, then we can put it in the jumbo rate so that they have a much better rate than actually they would in a conforming rate. So not all lenders maybe be able to do that, or they have different rules and regulations. I don't know how you guys,
I'll support that point. I mean, typically, yes, as Sheila alluded to, they are higher on the jumbo financing, but big banks really have done this for some time now. They're actually buying up the market. So they'll offer great pricing on jumbo financing because they want the depositor to a relationship with the client. So, so that's a caveat that's important to highlight, as Sheila alluded to with her business. But I mean, even with conforming rates, as we just alluded to, I mean, we're seeing rates on different loan products, high 3s, low 4s. So
borrow money. Borrow money. I mean, it's cheap. It's cheap. Yeah. So with regard to appraisals, and maybe Erin, you can speak to this owner as well. What's the process now? What's the series of steps in, getting pre-approved? When do appraisals get ordered, especially with a mortgage broker?
Absolutely. So when I started in the industry back in 2005, we would just call the appraiser ourselves and say, how much do you think this property would be worth? And then, if it wasn't what we thought, we'd call another one. So, that was like, the modus operendi. It was like that's how we did. That's why they changed the rules.
The good old days.
That's so now it's a little bit, or I should say, a lot more hands off. We don't call the appraiser. We don't talk to them. The appraisal report is actually ordered through the lender from an appraisal management company that works with the lender, and it's very hands-off. So and that happens once the loan is registered. So once we structure the loan, we're in escrow, we register the loan. The first thing we can do is order the appraisal.
Mm-hmm. Yeah. Good. And that time frame is pretty quick.
That's very quick. Yeah. That's very quick. They disclose, and then the borrower signs disclosures. We order it right away. And we don't want to waste time because obviously there's going to be some contingency period there. So we want to make sure we meet all of those. So speed is very important, and that's, I feel like, one of our strong suits is getting things done very fast.
Good.
Can I add? Sure. So the appraisal process is actually something that should get more attention because it's the one piece of the puzzle that none of us really have control over, and you guys do a great job of negotiating deals for your clients. We do as good a job on the loan side, but it's actually a third party who provides their opinion at the end of the day, right? So it's important to have flexibility in the process, I believe, with the appraisal process. For example, there are lenders out there that will accept transferred appraisals.
Transferred?
Appraisals, no. I'm seeing that 90% of our lenders that's out there can accept transferred appraisals where the appraisal can be transferred to the lender. So it's important to understand that if for whatever reason, if a lender doesn't work for your particular for that particular deal, you're still able to keep that deal in play with another lender. And also, as South Bay Equity, one thing that I like to note is we have our own in-house AMC, as Aaron alluded to, and these are local appraisers, like appraisers who have grown up in the South Bay even. So I'm sure you guys can attest to how important that is to have, for an appraiser to have a local knowledge. I mean, I'm sure you've had out-of-town appraisers on deals that you worked on, and it's just, they don't understand the nuances of our market. So I think local appraisers, working with them as much as possible is key. So.
Yeah, I think appraisal, even though we don't have any communication with appraisal, even at the big banks, they make sure that the appraisers that go out are within the community, and they make sure that within the area, because obviously if you go from here to there, and especially in Palos Verdes, you have view, you don't have view, it makes such a big difference. So definitely local appraisers are used. And then I don't know if brokers are different, but with appraiser and all the changes that were putting in place with intent to proceed, where you have to wait the 3 days, before you can order appraisal, the clients have to sign and make sure that they're moving forward. With B of A, we actually don't wait. We actually order appraisal without even collecting the fee. So we order appraisal as soon as we lock the loan and transfer the loan. So we have appraisal pretty quickly. I think they decided that they may be out of money, if 7 days goes by and you don't have a credit card and we already have appraisal back usually, then they are willing to take that risk and not wait to order the appraisal to meet contingency. I don't know, are we taking questions?
Sure. So with B of A, I've had it where I've been the listing agent a couple times, and the buyer's agent has used a local B of A representative, but we've had appraisers who've been sent to appraise the property that are from very far away. And it's happened twice. In both cases, the property did not appraise because the appraiser didn't know the area. They were from Monrovia or San Clemente, and they completely got it wrong. So then, I allowed the buyer to use a different lender, and then in both of those cases, because it was a lender that they knew used local appraisers, both times it appraised without a problem. So do you know, this has just happened in the last year and a half, how you make it so that they are pulling an appraiser that's a local appraiser versus from somewhere else?
Usually, when I look at the appraisals, I look and see, there's like 4 or 5 appraisers that do the hills that are part of LandSafe or CoreLogic. We changed from LandSafe to CoreLogic. So hopefully maybe that has changed, but we can always also, I don't know whether.
Well, it sounds like you're saying I can say to the buyer's agent, hey, you need to talk to your B of A lender, and they need to look at the appraisers that are being offered and make sure that
Correct.
It's only selected from a local. I didn't know that the buyer's agent could talk to the B of A agent and ask.
You can always talk to your MLO. You can always talk to the agent, and I don't know who the B of A lender was, but we can always also go back and say we don't agree, and this is the reason we don't. We can actually challenge it and say these are the comps that should have been used.
I don't know. I was told that one B of A appraiser appraised it for $100,000 less, and this was a $750,000 townhome, so this was not like a multi-million-dollar property. And I was told it couldn't be challenged because it was so far off that there was nothing that would be reviewed.
Well, there are, but I think that's it's an interesting point to really have freedom and feel that you have some kind of relationship or awareness with the mortgage loan originator, MLO. Say, hey, and if they're non-responsive, I guess mark them off the list.
Well, but as a listing agent, I don't have the relationships. It's the buyer's agent.
Well,
but to be able to
listing
say,
agents
But you should have a
"Hey,
relationship.
yeah.
I always call the listing agent as well as the buyer's agent, because you definitely want both people on your side, because you need to communicate, both sides. Hey, I'm the lender, who's the appraisal contact, So that's a communication that we need to have. So if it's not happening, then that's not the right thing. So,
Right,
yeah.
right. Well, as we're talking about, actually being in the middle of a transaction, you've got a residential purchase agreement in place. What are some of the tips that you would give to the realtor community about the RPA? I mean, I see RPAs every day. And while it's a 10-page form that says the same thing, the nuance and the variation from realtors is extraordinary. We still see some RPAs that come in asking for termite inspection. Mm-hmm. Tell us what you would recommend, just nuggets,
Yeah, can I offer a couple of things? So with regard to the purchase contract, my suggestion would be don't put anything on the purchase contract that you don't want an underwriter to scrutinize. I mean, that's what their job is. They're, for lack of better words, they're kind of paranoid. So when you put termite inspection, they think that the house is filled with termites. They are always looking for things that they can
and what about like personal property included in the purchase?
Same thing. If you say it's going to come with personal property or whatever, then they're going to want to make sure that that personal property was taken, and everything has to be done to the letter of the law, basically. Mm-hmm. So to make it simplified, just put whatever you think is most important. One thing that we see a lot of times is people will put cost for repairs, credit for repairs. And when you do that, you're just basically saying there's a lot of problems with the house. They're going to want to make sure those are fixed, and they're going to want to have the appraiser go out. Yeah,
so it's better to do that with the request for repairs outside of the RPA and in the normal course of business. You're all nodding because you're very good realtors, but you know this stuff.
To expand on that, that's a great point.
Sure.
I mean, you could just structure it as a credit towards closing costs.
That's it.
Now, is there a percentage, is there a max on that anymore? I remember there used to be like a 6% magic. Is that still the case?
Yes.
But it really doesn't become, I've never seen it really in this market because of the prices that we're dealing with. I mean, it never really becomes an issue. Because even at 10% down, we're looking at 3% selling concessions allowed. So, other markets like Scottsdale, where I started the business, I mean, that was more of an issue.
Can you combine recurring costs and non-recurring costs in credits?
Yeah, that used to be the case, but I just want to put it out there. You can pretty much have all the closing costs be paid by a seller credit or a lender credit. Now, I mean, whether it's recurring or whether it's non-recurring. And just so you guys know, recurring costs are like prepaid interest, like hazard insurance upfront, hazard insurance that's collected. That's an example of a recurring cost. One-time costs like other charges, they can definitely be taken care of.
Yeah, it's just easier to say $10,000 to a closing cost. You don't have to say recurring, non-recurring.
Yeah, right.
Just make it closing costs, and then let's make sure we get the amendment to the lender, sooner than later, so it doesn't delay the process. Because it used to be that we actually had to send it back to the appraiser for them to put it on the appraisal. Now, actually, we don't need to wait for that anymore.
Oh,
but we
that's a
do
good
still have to
change.
have it because it needs to be on the closing disclosure. And it does change the numbers. So definitely, if you know you're going to have that, let's get it to the lender, have it signed by both buyer and seller, and get it to us as soon as possible.
And don't forget to get it to escrow in between all of
Yeah.
that.
No, we actually have to get it to escrow
That's right. That's the
to get it to us.
It does happen. We're like, what credit? Oh, right, Nora? Just now and then. And we really can appreciate that you're in the throes of this negotiation and you're doing your job. You've hammered down on the seller, you're getting money from them, you agree to it, you maybe even let your mortgage loan originator know that that's happened. Just flow that through escrow, because typically, are you not going to want to see an amendment from escrow?
Yes, that's what I was wondering.
And an
yeah.
addendum to the
Sure,
contract?
sure.
Both?
Just an amendment.
Is that
Amendment.
the case with all of you, typically, just an amendment? Or, could it be an addendum without an amendment? No.
Typically, we need the amendment, but the escrow officer, like you mentioned, it's not going to probably make the amendment unless they see the addendum from you guys.
Yeah.
So that's the key. You guys start that process and then give it to,
Yeah, it's
We can
it's an
have one
interesting
without the
point.
other, though. We can
You
have the
can,
amendment.
and that I
yeah.
think changed a little bit. Do you remember, Nora, that seemed like the lenders, especially the big bank lenders, were like, oh no, we need an addendum, changing the RPA, and we need an amendment, changing the escrow instruction. And again, this is all, I love the timing of having this talk because you're seeing they're kind of relaxing a little bit, right? They're not as uptight. You uptight lenders, my gosh. Just to get into some specifics, Sheila, tell us a little bit about the special products that B of A has. I've heard about doctor programs. I've heard about qualifying without the traditional documentation. Maybe you can speak a bit about what's new and interesting that these folks might need to know about.
Sure. So we have our doctor loans, which is basically 5% down up to 1 million loan amount, and 10% down up to 1.5 million loan amount. So this is without no mortgage insurance. And then if they have student loans and they're deferred for 12 months, we don't actually need to count it against their debt. So it's a great product for especially new residents, fellows, people, because most doctors have, student loans. So it's very, very helpful. And the down payment, if they're doing 5% down, it must be their own money, it cannot be gifted. But if they're putting 10% down, 5% can be gifted, the other 5% has to be their own money. The rates are very comparable to the conventional, sometimes even better. We do require 720 credit score for the doctor's loan. But it's an awesome program to get people into homes, without having to have all the other, caveats that go along with the regular conventional loan. That's for dentists, MDs. You do have to actually, practice, not research, not PhD like in psychology. It has to be a certain professional in the MD. So that's one of our niche program. We also have what is called Buyer Ready. So Buyer Ready, now it's a program that you don't have to have a property actually chosen, but it's more than a pre-approval. So we don't do pre-qual, first of all. There's no such a thing, I don't think, as pre-qual anymore. We actually have to look at everything in order to generate a pre-approval. And a pre-approval means we've looked at, your assets, your income, your credit score, and you're pre-approved. So we do mini underwriting ourselves, right? So a buyer ready is actually we send it to underwriting and have you conditionally approved by an underwriter that when you do find a property, then we can close in 2 weeks. So we just ordered appraisal, escrow, title, we're done. You don't have to even have loan contingency. So if you are actually competing with cash buyers, you don't have to have loan contingency. That is good for 150 days. So it is an amazing program, especially for those self-employed borrowers that have tax return galore, corporate returns, and it's not like for your W-2, regular borrower. I mean, we can do that too, but if you have bonus, if you have commission, if you have income that needs to be more analyzed, then we have an underwriter already reviewed it and you have loan approval.
I love that idea because, again, from the escrow perspective, we see sometimes the client thinks that the go button is when the contract's been approved or received, by the seller. And often the client has a massive amount of underwriting that may need to occur. And you put yourself in such a difficult position when you have a 17-day loan contingency or otherwise. And, everyone's stressed from the beginning. What were you going to say, Owen?
Just on that point, I think, that is something that we see that can make things a little bit more stressful is like on the front end, we need fees from escrow to be able to disclose. So this is where a great escrow company like Wendy's can help, an escrow office can help because facilitate that. So as soon as we get that contract acceptance, that's when our the close of escrow period begins. So it's really important for me to work with you and get your escrow contact, and I can call them for you and just ask to expedite their fees so we get their fees and be able to disclose the loan right away, because you just don't want to lose days on the front end of a transaction.
Yeah, all about stress reduction. Good. Do you have anything else? You have?
Yeah, we have also, I can go on forever, but I have 4 pointers actually. So those were the 2. And then we have the buyer ready, that was a buyer ready. We have delayed financing, which is for those buyers who buy all cash. So, many times at the bank, we have people coming wiring, $1 million. I'm like, where the hell is this guy going, you know? So they buying all cash. So if they come back within 90 days from when they close, we can actually give them purchase rate and a purchase guideline and do a purchase transaction after they close and treat it as a purchase. So within 90 days from the time they close, if they bought all cash, they can come back and we can basically redo it and give them their money back. You know, maybe they did the all cash because they had to, because of the market, and you have to compete, and that was a way for them to get it, but not necessarily they wanted it to put all their money into the property. You know, maybe they need their money, put it back into their assets and make money.
Because before this type of program, you would be looking at refinance rates.
Correct. That would be in a
different
cash out
than
refi.
a purchase rate. So I love, again, this sort of, we're going to work with you in your scenario. And I think, as realtors know, the competition for cash deals and contingency is pretty high when we have such a competitive market with low inventory. Sellers don't want to, put up with too much.
Some of these products, like this one, we do it under our enhanced guideline. So the enhanced guideline requires $500,000 in assets. It doesn't have to be liquid, but a lot of people who are doing all cash transaction do have that kind of money sitting, in a 401k or an IRA or something like that.
Yeah.
And then the last product that we had is asset depletion. So for clients
that
doesn't it? It's depleting your assets.
Even for those with depleted
It used to be called asset dissipation, so
got it.
I don't know why they changed that exactly, because you're pretty much depleting your asset, right? So, and that's for people who are mainly either retired or semi-retired or have high worth net, basically. They don't work necessarily. They have trust accounts, and we see that, or they're retired and all their money is basically in their assets. So we actually have a formula that we use, and we deduct the down payment, closing costs, and all that, whatever asset is left over. Then we have a calculator that will give it a certain income, and we can use that income toward qualifying.
That's good.
And if they have Social Security and pension, we also add those into the mix. If there's a co-borrower who is just a regular W-2, we can also add that. So there is more to qualify on, rather than saying, oh, you don't make any income, so then you don't qualify.
Good.
So those are the 4 different, there's all kinds.
Well,
but
it supports the fact that even with, if you will, consider big banks, B of A to be a very conservative kind of lender, right? They have their program, they have their underwriting guidelines, they have certain systems. There's still this sort of loosening and looking at common sense applications again, and I think that's fantastic. Erin, are there actually easy qualifier loans or non-qualifying, or in my day, the NINA, no income, no asset, doesn't matter, right?
Absolutely. We don't have Nina back. I remember those days.
The fast and easy with, hold on, maybe Matthew will come help you with that. Remember the countrywide fast and easy loan?
yes.
We called it the Pulse. You have a Pulse
This sign. Yeah. I remember those days.
Yeah, we do have some loans, a few loans that are out of the box. I mean, most of the loans we do are your standard conventional, jumbo, that kind of thing. But as the market changes, we see rates going up, things like that, these other products become more appealing to investors. And that's why we're starting to see them come back. And one of them is a cool product that I think a lot of realtors actually like it. It's an easy qualifying investment loan. And so what it is rather than qualifying based on your debt to income ratio, this particular product uses the cash flow of the subject property. So you could have a property, maybe your tax returns show you have a lot of write-offs or something like that, and it's not enough to qualify based on traditional debt to income ratios. But if the property itself cash flows, if the rents, the market rents are more than what the principal, interest, tax, and insurance are, then you can qualify for that type of financing. So that's one.
What kind of down payment does that take?
You need 20% down,
20?
at least, yeah. So not too much.
Yeah,
I mean,
yeah.
It's definitely, you know, and the rate's not that bad. It's in like the 5% to low 6s, right around there.
Well, with
So-
rents, that's probably really not too bad. I mean,
Yeah.
rents are so high now, too, on these investment properties. Incredible. Can you loan to entities, like in a situation if you have an LLC or a corporation, is that an option?
So trust, most lenders will lend to a trust, and that's pretty.
Most lenders will loan to a trust
Yeah,
now.
that's pretty
They don't have to
standard.
pull it out and
That's-
put it back in,
yeah,
which is
I
a
mean-
huge risk.
Exactly. So that's typically the case, but some programs, like especially the, you know, your non-QM loans or loans that are not, you know, fit the guidelines for agency, they may ask you to take it out of the trust. So it depends. It's very program specific.
But corporations, LLCs, when you're looking at investment property, is that an option? Are there?
Sorry.
Are there
Corporations, LLCs, it's typically going to be your non-QM that'll do that. Yeah, your conventional loans won't lend to corporations and LLCs.
Got it.
It's going to be a specific loan for that. Yeah.
Owner, do you have options for entities like LLCs, corps?
Yeah, as Aaron alluded correctly, I mean, in the non-QM space, which is what I specialize in.
Does everybody know what QM stands for? Can you explain what that is?
Yeah.
I mean, maybe just, we kind of
He used
went
to
over
be a
that.
mortgage guy. He crossed over to the other side,
To the dark side.
to the dark
So
side.
maybe just give us the definition of qualified mortgage. I mean, it is something that came out of sort of the meltdown, the Dodd-Frank fix, right? What is a qualified mortgage so that we understand?
Okay. Well, qualified mortgage was put in place with certain standard that was set by the government, federal government. And those are the type of loans that are less risky, basically. Most of your conforming loans, the debt to income ratio at 43%, not interest only, not over 30 years amortization. So if the clients cannot, you know, basically reduces the risk of getting sued by the clients, no balloon payment. So basically, the certain standards were set by the federal government that no risky business, you know, no risky loans, and those are qualified mortgage loans. So your jumbo loan doesn't fall under that, and any of those products that I just mentioned doesn't fall under that. So that's basically what it is.
So when you're speaking about non-QM, right, that's a different world. Than
So, what happened with Dodd-Frank and all the regulation and compliance is it created an opportunity in the market for lenders to realize that, look, there are a lot of creditworthy borrowers out there that don't fit the box of QM for different reasons. They have great credit, they have a lot of equity maybe that they're putting into a purchase, or maybe they have in their homes, and they have a lot of assets, you know, with the asset-based loans that we're talking about, but first they weren't able to secure this type of financing. So lenders started coming to the market with these type of products. One is we call portfolio lenders, lenders that don't sell the loans in the secondary market necessarily. So these lenders introduce these products, and they're, once again, I mean, they're sound loans. They just serve a certain niche in the market. And it's just, to me, I look at it, so an FHA buyer can get, with a 580 credit score, 3.5% down, buy a home, yet someone with all this equity on the hill, let's say, and they want to work with that equity to purchase a new home or what have you, or they have a lot of assets, they have great credit, they've always shown they're responsible borrowers. It's just, I started looking at it and I said, there's got to be a way to help these people. And that's why I got into the segment that I did back in 2013. And it's grown, I mean, exponentially over the years now. I mean, life insurance companies have now started to get into the secondary market on these loans. New York Life, for example, invested $29.5 billion in 6 months in 2018 a loan into the secondary market for these loans. And they're actually one of the smaller ones. You got much bigger Aon, AIG,
Wow.
that they're getting into it as well. And so you're going to see, as you were alluding to, loosening of guidelines. You're going to see just more lenders with more appetite to do these loans. And I think it's great. Like, for example, asset-based, just to piggyback off of what you said, the asset-based loans. So now you have 10 different lenders that can offer that. Competition is good for everybody. So now they start to get more aggressive with their formulas. Now you can get all the income from assets, for example, like she was alluding to, but also on top of that, you can get better rates as well, because they're competing against one another. So you can get an asset-based loan with rates in the low fours easily through a portfolio lender.
So is there a response from those insurance companies or the lender community that has an appetite for this stuff? Maybe they're not traditional lender, they're big money organizations that want to fill their portfolio. Are they looking at existing guidelines and then kind of getting outside the lines to be attractive? Are they simply competing in the same kind of guidelines but opening up more dollars? I'd like to see, and I hope that you can tell us, that they're looking at the unusual, the more creative, they're open to an application that may be way outside the box.
And I think it's both. I think it's seeing the opportunity that Fannie and agency loans are able to fulfill, and they see, the average credit score for a home buyer in the U.S. is 674. 674.
Average credit score?
Credit score is 674 for average. They're 34 years old.
In California?
Not in the U.S.
In the U.S.
So the average credit score for agency loans is 700. So there is a big market out there to be filled, once again, and they see that. So they design these products to fulfill those niches, and these loans are sound underwriting. They have good interest rates. I mean, they have equity in them. So, like, the foreclosure default rates are very low on these loans. So, but it's also a bit of both, what you're saying. I mean, it's like, for example, lenders have just gotten more and more flexible with the amount of money that's pouring into the space.
Yeah.
So I have one of my non-QM lenders. There are 40% of the loans is done on an exception basis, meaning even outside their own guidelines, which are something different, they're doing exceptions on top of that because they see that it does make sense. Because at the end of the day, it all comes down to common sense underwriting. And what's common sense? Well, 5 years ago, it wasn't as common.
Yeah.
But now it's more common. So if everybody is doing it, or if more lenders are doing it, then they feel more comfortable with it. And
Can you give us a quick example of something just unusual or interesting, or that you've recently or in the last couple of years put together? That no one else on the planet can put together except for you.
So I had a buyer who was buying her forever home as a new build, $2 million purchase, and great business, 13 years in existence. She generates $60,000 a month in revenue. Yet, because of a situation with a family, a daughter, she didn't have a lot of money to put down on that purchase. And on top of that, she's a small business owner. She's self-employed. And like a lot of people out there, self-employed people take deductions on the taxes, and understandably so, especially where we are in the state of California. So she couldn't qualify for a traditional loan with her tax terms. So I set up what's called a bank statement loan, which is all in the packets that you guys will see in my folders. It's basically looking at the deposits that are going into a business bank account for the past 12 months. Actually, it was 24 months. So
Deposit, so like a cash flow kind of
cash
thing.
flow, exactly. And no one was willing to do that loan. This was a year ago, February. And no one was willing to do that loan because of the size of the loan. It was a $1.9 million loan with 10% down for a bank statement financing with no tax terms. And similar to what I just said, I found an investor who was willing to make an exception to go above their max LTV of 85. We got to 90. We closed the loan. I mean, she's got a high credit score. This is a forever legacy home that she's going to pass on to her daughter. She will never default on that loan.
No, right.
And And the fact of the matter is, I mean, it's interesting because lenders back then, a year ago, I had only one lender. I had to get an exception to this loan. Now, I have a similar situation, similar scenario. 12 lenders that I had that were willing to offer. Finance.
I attended an economic forecast breakfast last week over at Terranea with Christopher Thornburg. If you ever want to look at Beacon Economics, Christopher Thornburg, really, really interesting PhD economist. And he was saying that we have the safest mortgage environment in the history of banking because we're looking at everything. We're not just looking at the Pulse loan now, right? We're really qualifying the property. We're really qualifying the borrower. Even if it's outside guidelines, you still get the sense of this is a good bet. And the default rates going forward over the next decade from this mortgage environment is going to be incredibly low. So it's just good for real estate, it's good for the economy, and I'm excited. And you know, something else I was thinking about, owner, and please finish what you're going to say, but these folks work really, really hard at the submission stage, right? Before their underwriters even see the package, they've underwritten it, and I can promise you they're smarter than most of the underwriters. But certainly from the, wait a second, if we back this out and we move this to the left and let's try to, so I really respect what you do and how hard, just like our realtor community, escrow, we get paid when the deal closes, all of us, right? We're very motivated to work on transactions that have merit, certainly, but to go the extra mile. And when you get a loan originator with you that will listen to your story and really work that file, it's golden. So it's a very important relationship. Owner, I cut you off. Did you want to finish saying something?
Just on that point, we all have resources to internally, beyond just originators. We have people at the office that have done underwriting in the past, that have done, that have been in that world. So if there's something that we might not even, we might not be sure of, we can go there. And we have relationships with our lenders, and they want our business. I mean, they're fighting for it.
There is an appetite for that, no question. Talk to us about some of the interesting programs you have at Redondo Mortgage.
Absolutely. So I mentioned that investor program. That one's really good because, as owner mentioned, a lot of people, they might not qualify, and so they need other programs. Another one is a program where you use profit and loss, the profit and loss statement
of a business, so it's a business owner.
Correct, correct. So we could use that in lieu of a tax return.
Wow.
And
and it doesn't have to be audited, it can just be out of
That's
your
correct,
QuickBooks?
It's not audit, correct.
2 years,
correct,
3
correct.
years?
Just year to date.
Is that right?
Yeah, year to date, yeah. So.
I mean, that opens up, doesn't it, Judy? I'm hearing Judy go, call Mr. Smith. I mean, there are buyers that you can go back to, right, Mercedes, and just say, did you know that there are some options? And, one question I wanted to ask about that deal that you did, was there a significant rate impact on that deal?
So the rates are going to be at a premium compared to traditional financing. But it's not like we're talking about hard money here. This is not hard money. This is rates with no points from the lender. Right? Lenders don't charge points for these loans. The rates tend to be, depending on the situation, right? Now that more players have gotten into the space, rates have gotten better. Like right now, if I were to originate that loan, I could get rates in the 5s with a good credit score. So in the 5s. So we're talking about maybe a point, a half a point, depending on the situation. So I mean, each lender does things a little bit differently. Some lenders focus on the really high credit profile within this space, of this non-QM. They only do those type of loans, but then there are other lenders that even offer other types of solutions for people who need it, maybe because their credit is much lower for different reasons. And the way I work with these people is it's a multi-step process. I mean, if they need that loan to get into that property, yes, I'll help them with that, but I'll also have an exit strategy already worked up from the beginning, where I will work with them, whether it's their credit, whether it's something else, over that time, refinance them into a conventional loan or And, you know, and so it's, at the end of the day, it's helping them.
Well, you're taking care of the client. I mean, right, we all are wanting to serve the client ultimately, whether it's like, hey, you know, go talk to Sheila at B of A, she'll be able to, you know, help you out, and vice versa. When you can't do a deal, you certainly
I
want to still be
absolutely
able to
said
make a
that, yeah.
referral.
Yeah.
Some of the other deals that Redondo does, and I have to ask about it because it's a loan I love, and people go, are you crazy? That's just, is the reverse mortgage. I think it is a brilliant product, and I know Redondo Mortgage does them. I don't think either of you two gets involved in reverse mortgages.
Yeah, this is a great program. I actually did one last month for my grandmother. So my own grandmother. So she came to me and she said, you know, I heard you guys do this program and I want to know more about it because my grandfather had passed away, and so my grandmother was she has a nice house in Redondo Beach, and she was, you know, on fixed income. My grandfather was receiving retirement. He passed away, so that income stream no longer there. So she needed something. She was house rich but cash poor. She couldn't afford the payment, right? So I said, wow, yeah, this is this is perfect for you because this is what it's designed for. You know, it's not designed for everyone. This is it's a specific type of scenario where it could really help. So yeah, anyways, we ended up getting it and it was fantastic. Now she doesn't have to worry about making the mortgage payment. That's the beauty of it.
So how does it exactly work?
So basically, if you recall, back like when I got in the business, like 2005, there was a program called negative amortization, if you guys recall that. So it's a very similar concept. Instead of making the payment, the borrower foregoes the payment, and what happens is whatever they would have paid gets added to the principal. It's amortizing negatively rather than a forward mortgage that's going down every month. This one's going up. Yes, exactly. So they don't have to pay the mortgage payment, but then the principal balance is increasing over time. And what's great is that you know, they don't, when they do pass away, the note's going to be due. But one key thing that I don't think maybe many people know about is that they will only owe 95, the lesser between what they owe, the loan amount, or 95% of the value of the home. They'll never be upside down, which was a big concern for a lot of people. The heirs were like, you know, when I talk to people about reverse mortgages, the first thing they do is talk to their kids, and their kids are like, no. But
you have to give the deed to the bank.
Yes.
I mean, I've heard this.
Correct.
You know, that's that concept.
That's the stigma. But then when they come down, I say, okay, have your family members come and we'll sit down, we'll talk about it. I go over the details of it. They think, oh, why? Why didn't we do this earlier? I mean, it's so,
it's a way to keep folks can stay in their home, enjoy the equity in their home that they can't tap into without borrowing it and then not having a payment.
Yeah, I think the misconception is that somehow the bank owns their home.
Right.
Yes.
Explain them, it's just a mortgage, the same as a forward mortgage. It's an amount you owe, and when you leave the home, you have to pay back that loan, and any of the other equity goes to you or your heirs. And that's the big misconception, somehow the bank owns the home.
Well, and the family now,
Goes up over time.
yeah, I think it's awesome. Can you do a reverse mortgage as a purchase loan?
Yes, that's another thing that's really cool about it. You could do it as a purchase loan, so realtors can utilize this. If you have a borrower you have to be 62 or older.
I almost qualify. I'm getting close. Which is why I like this product so much. Right?
So, yeah, so if someone has money, they want to put a large down payment and they're, you know, retired, they don't have that income.
How much of down payment would they have?
Well, it depends on their age. So the older they are, the less down. The younger they are, the more down.
So this is, so this is just sort of a judgment.
The percentage of down payment?
Yeah.
It depends. Like there's a schedule. So depending on a few factors, like the value of the home, the purchase price, and their age. Their age is a big factor, and also the interest rate. So depending on that, there's a calculation, and so typically, you know, you're probably going to need around between 40%, right around there. Yeah, in most cases, yeah. Yeah,
If you're 62,
yeah.
it'd be over 50.
It's going to be over. Yeah, yeah.
But you can almost kind of see a design, a scenario where that might work, right? You know, somebody moving from wants to downsize, but doesn't qualify for
That's it.
a monthly payment. Yeah.
A bunch of cash from when they sold, you can put it down.
And you can transfer your taxes, right? It's just, I think it's a really worthwhile tool to think about. Questions? Yeah, we're happy.
Then when the heirs, like, they have to refi, or how does that work?
Yes, good question. So once the person passes away, the borrower passes away, then the heirs, they have about 6 months to a year to handle either refinancing the property or selling the property. Somehow they have to pay that note. But they'll work, the lenders will work with that. And they're not gonna be like, okay, the person passed away, you better pay it now or else we're gonna foreclose. They're not gonna do that. They're gonna give you time and they're gonna work with you so that it's a smooth transition.
But the borrower has to remain in the property too. I think that's another factor.
That's correct.
Right?
That's correct.
They can't leave it more than 6 months?
That's
or,
correct,
yeah.
yes. So it has to be owner occupied, that's one of the caveats. And they also have to be current on their property taxes and homeowners insurance. If they're not, then that's gonna be a red flag. The lender's gonna come and say, hey, what's going on, and check into that. So that's really important.
But that homeowner is going to pay their own taxes and insurance. That is one expense they will have with the homeownership.
Correct. They
right?
need to
They do
pay.
have to be able to do that.
They need to be able to
And
pay.
you underwrite to that.
Yes, but if there's times where the borrower, maybe it's tight for them, they can't afford that either, they can have that included into the loan. It's similar to impounds. You've heard of impounds, right? So where the lender takes the taxes and insurance and puts it into the mortgage. So that part could be also impounded in a similar fashion. Yeah, if they can. Yeah.
Has it ever been that they live so long that then there's not enough? Do you know what I mean? Like, I'm watching a reverse mortgage now for
Sure.
this 92-year-old lady, and I'm watching it
Right.
creep, and I'm thinking like, geez, what if she lives for 10 years? Then what?
Yeah, so very good question. So if she lives forever, for 200 years, obviously it's gonna be upside down, but the most the heirs will have to pay is 95%. So that's great. We want people to live a long time.
So the
Yeah.
homeowner could continue living.
Yes.
The loan to value is at 95. No one is going to call that loan due.
Correct.
Is that right?
And
You
it-
just continue to live in your home as
Cor-
you have been without
correct.
any payments.
Even above 95, if it goes up to 120, 150, but the most that they'll have to pay back is 95.
That's really
Yeah.
interesting.
Yeah, that's I think one of the main.
So that 5% covers closing costs. I mean, you can basically get out of
Correct.
the property, pay commissions.
correct.
Yeah.
Correct.
Wendy,
like it.
I wanted to add something. We just added a new program. You and I were talking about it, and I totally forgot about it. In December, it's called Intent to Sell. So a lot of times people are not selling because they're like, where am I going to go? What am I going to, what can I afford? And they have a mortgage on their current home. So this is for the people who have a primary residence and they have a mortgage or don't have a mortgage. So the intent to sell is, I'm gonna buy a new owner-occupied property, but you don't have to sell your house in order to qualify for the new house. So what we do is, if you have 30% equity in your home, and if you have 24 months reserve of PIT, if you have a mortgage on it, and a lot of time people don't necessarily, but if you do, 24 months reserve of PITI, principal, interest, tax, and insurance, and then whatever loan that you're getting on a new house, if it's a jumbo, you need 6 months reserve or whatever. So if you have that, and you can have either a letter saying, I'm going to sell this house, or you can have a listing agreement with the realtor that you are going to be selling the house, then we don't count that debt against you.
That's awesome.
That is that just came out in December,
That
and
is
we're just so
great.
excited about that program. So
Especially in a market where there's no inventory.
Yeah.
Sellers don't know what they're going to buy, right? And at
So
least
yeah, a
you
lot of
can-
times they don't qualify. They're like,
Yeah.
because I have a mortgage on.
Is there any issue if they decide not to sell and just rent it out after the transaction?
Oops.
You know, it used to be, so how it was, and I think how they came up, yeah, I mean, we haven't come across that, I guess, yet, but where we used to, people say, I'm going to lease my house, right? So they were coming with lease agreement and the first month rent and the deposit of the rent in their checking account. So then they find out, oh, you know, this is happening way too many times, and people actually are not leasing the house and they're actually selling it after they close. I think that's how they got, you know, because that was happening. That was one of the rules that we had, you know, and we still, you know, so they kind of, I think, tweaked it, you know, and so now we're, you know,
It
this
makes
is
so
where
much
we are.
sense.
And, you know, and then the other thing, you know, we talked about, so exceptions, you know, we actually, if they have assets, then we go up to 48% on our jumbo loan with an exception. So if they have good reserves and good assets, we can go up to 48%. So banks are even, you know, I mean, these guys obviously are the masters, you know, and they have many places to go. And, you know, we're just, you know, one entity, you know, it is what it is. But there are exceptions. So that's just kind of what I wanted it to, you know, we do make exceptions. It's not just, okay, you know, 43% or 45%. And if they're, you know, we do a lot of different things when we bank a lot of people, you know, and so.
And to that point, I mean, one of the incredible advantages that the big bank has is to incentivize the relationship, right? Speak to that. I know that I see my husband deal with this sometimes. Like, well, if you move that $1 million from this bank to my bank, I can better your relationship banking. Is
I was
a
actually
big
texting
deal.
your husband last night. He was like, how are you guys making money? I was like, I don't really care how they're making money as long as we close it, because our rates are absolutely out of, no one can really compete with us in rates.
It's incredible. It's incredible.
So if there are platinum honor clients, which means they either have $100,000 with B of A for an average of 3 months, or if they have $250,000 with 1 month. And it's not just B of A, Merrill Lynch, US Trust are our allies, so that we all are one. So if they have money with them as well, so they get a 0.5% discount on the rate. Now,
That's huge. That's rate,
That's-
not just
yeah.
cost. That's giant.
and then
money.
if they bring money over after we lock the rate, then they can have an additional discount. So if they bring 250,000, there's an additional 8 discount. They bring 500,000, it's a quarter. If they bring up to $1 million, that's 3/8 more discount. So
Erin's going,
literally, it's like, what? It's crazy. It's crazy. If you have clients that are B of A clients, I mean, you are really not. You're not doing a justice to them not having them to talk to, you know, a B of A. And don't have them call the 800 number B of A person, please. You know, just have someone you know that is gonna. It's not the same.
It's a great
It really
point.
is not the same. As much
Yeah.
as we want to think it is, you know, this whole digital mortgage experience that, you know, and we got, you know,
Quicken?
everyone his
Quicken
age
loans?
on their phone and, you know, all of that is like, you know, I still want to hold their hand, and they still need help, you know.
And they want it. Don't you
Yeah.
find that your clients want to pick up the phone and talk to
They can do the
Sheila?
app over the phone, over
Yeah.
the internet, but, you know, let us deal with the rest of it, because there's always a lot that happens, that there are questions and just things that they just need to know, you know.
Well, it's an intimidating process, to say the least, right? Buying a house, but then the mortgage and the long-term commitment of that is always an emotional thing. There are very sophisticated clients out there, and we all have them, and it's wonderful that their money manager is doing the talking with the MLO, but that's not that common. I mean, but we do see people with money in this area. You know, this economy, the South Bay, is just giant right now. It's so big with El Segundo, Long Beach, the port. It's a really exciting time to be in the real estate business, and I'm happy that we have these 3. Make sure you have their cards. You've got information here, and between the 3 of them, any deal can be done.
Pretty much.
Yeah,
Sounds
we
like it.
covered the game.
There are the unfinanceable. No money, no credit, no job. Okay, maybe not for them.
And are we getting to the end?
Yeah,
Oh,
just
well,
sure.
yes, I actually have Starbucks cards, gift cards for anybody who wants to ask a question.
Oh.
I like that.
I heard this at a Tom Ferry's training event back in December. He announced he said this on stage that prior to 2008, and we talked a lot about the meltdown today and the comparisons. Prior to 2008, $849 billion was refinanced, and it was to finance other properties, to speculate on other properties, to purchase other properties in the run-up, and to finance like frivolous things like cars. This time, $178 billion only has been pulled out, and it's been done to improve the value of properties and to pay off student loans because they've swelled up so much. My question is, like, in the South Bay, do you also see that as a trend in your refinances? Are people refinancing for the right reasons? Because we all get a little bit nervous, I think, on hearing about loan programs that are creative and flexible, like how we learned from 2008 altogether, and our people are actually doing the right things now.
Do you pay attention to the purpose of the refinance, or that doesn't necessarily have to come into the underwriting? Oh, does it?
We do. Yeah, I think we do ask questions. And not so much maybe refinance, because a lot of people already refinanced. Like, when I go back to my own pipeline and I look at it and I'm like, okay, well, who am I going to call? Rates are down, and let's see who I can refinance. I'm like, damn, they're all in the threes. It's like there's really no one to call except if they either have an adjustable loan, like a 7-1 or a 5-1 or a 10-1, that, it's a good idea. If you're going to get into a 30-year fix, this is the time. Or what we do is a home equity line of credit, and I think that was one of your questions. So a home equity line of credit is what you're referring to, where a lot of people on the Hill especially, or in the South Bay, really all over because of the value of the homes, there is a lot of equity in the homes.
So they can't write off the interest on those anymore?
No, not with the new guidelines of the new president, but I think there are some, if I'm not wrong, if it is used for a certain home improvement or something like that, there is still some rules and regulations about that they can. But they do a home equity, there's a lot of I do a lot of home equity line of credits, a lot. And sometimes it's just for emergency. For the older people is, while they're still working and they have an income, they can have that for emergency, Or for home improvement, a lot of home improvement is happening. I think you see that a lot. And also paying for kids' colleges. I see that a lot, just getting ready. My kids is going to go to college. It's better to pay with this rather than having a student loan with a high interest rate. Or they're buying another property. Do we like that? No. Do we want to tell the underwriting that? No. So I'm like, yeah, future cash use is a good idea, because you don't really know what you're going to do. But they do use it for buying an investment property. So those are kind of, and the refinance, I think, the same.
So if somebody has a HELOC and they've had it for about 6 years and now their rates change and it's variable, so it's going up every month, is that a good thing to refi that or refi them both together, add your mortgage and the...
Depends what their first mortgage is. Depends how
if
big
it's
is the
jumbo,
HELOC.
if it's jumbo.
So if they had a really good rate on their first, they probably don't want to, you have a scenario in your head. So so it depends. It really depends on if you put the first and the second together and you can still get a compatible rate to what you have, then that's a good idea. Definitely is something you want to look at. If your first is 4.375 and you can put your second together and you can still get 4 1/4 and you have a big second, then it's to your advantage to do that, because when it's due after the 10 years, you're going to have a big payment.
When you say when it's due, the HELOC has an end date when you have to pay it
It
off?
has, it doesn't have you don't have to pay it all at once. But 10 years is usually the draw period. So after the draw period, you either have to pay it back in 15 years or 20 years. The new ones are 20 years. The old one were only interest only. We don't do interest only home equity lines anymore because of that reason. Because people were ending up with a huge home equity line, they couldn't afford to refinance, and they were stuck with a huge payment. So yeah, or you can just redo your second. If it doesn't make sense to put the first and second, you redo it. The HELOC rates are about 3.99 right now.
I think it was like 2 when you got it.
But you know, it's an interesting question, I think, when you're trying to find, you know, the exact bottom of the market. And you never hit it. You bounce right off. Property values, it hits that low, and then it starts to go up. Same with interest rates. They're always in flux. My opinion is that if you can borrow money for 30 years at 4.5 or 5 1/8, that is a pretty good interest rate to have that much cash, whether it be an equity line or just, you know, borrow more and put less down on your purchase to lock in what are incredibly low rates, whether it's the blended rate. I mean, you don't want somebody to, you know, detrimentally affect their cash flow because they're going higher in rate. But for cash out, and for the purpose of cash out, even if it's investment, that makes a lot of sense.
On that point, this is going to be one of the biggest trends for 2019, which is cash out refinance.
Is it?
In the mortgage industry. Reason being is investors are what's driving this. I mean, they're actually, like, for example, if it's a debt consolidation loan, I'm seeing loan to values up to above 80%, 90, even higher. If it's debt consolidation, if they're putting themselves in a debt restructure into a better situation with their debts, getting rid of high credit card payments or other payments, getting a mortgage instead. And that's something that, as an agent community, you want to be mindful of, because it will allow them to put themselves in a better situation for a possible purchase in the future. So with what Bilge mentioned, I mean, with the equities that's out there, with the price, the value of the properties being where they're at, there's a lot of equity to be tapped into, and why not have that money go towards real estate? So it's the most proven, you know, investment vehicle. So it's something for you guys, for you to be mindful of that is going to be.
Okay, so my question on that topic is, are you all opening escrows for refinances, or do you do that in-house? You need escrow.
Escrow.
We don't.
We need escrow. Guarantee
know.
Okay, call
escrow.
these two guys.
You know how it is.
I know that on some HELOCs and second trust deeds, some of the big banks are not really requiring an escrow. They do things in-house.
Yeah,
and
yeah.
it, you know, it's simpler. But for a mere $665, you can get your refinance with a guarantee escrow.
And see, our clients, our customers, our investors continually asking us that they invest a lot of money. I'm doing several projects with them. The question about the forecast of interest rate. Now, my question is related to the bond market. As we see the bond market keep going high, the interest rate coming down. What's the relation?
Well, you're usually in one or the other. Yeah.
That is exactly right. So when
Yeah.
the stock market is doing well, then the interest rate goes up. And so that's usually how you can gauge, we look at the LIBOR. So that's basically how we gauge the interest rate. As you see the economy doing well, then the rates, the stock, when you see a bad day in the stock market, that's when the rates are doing really well.
Yeah, typically.
So that's typically how it works. I know you have your hands going.
Yeah, so the mortgage-backed security market is, the Fed funds rate is not actually what determines your mortgage rates. So it's important to understand the distinction between that, first of all, how the bond market reacts to what's happening in the economy, right? So when the economy is doing better, as Sheila mentioned, there's going to be pressure on rates. But this is not it's not isolated by itself, and there's other factors involved, like with the stock market. Like in December, we had the worst stock market since it surpassed the Great Depression. So we had the highest rates in 8 years, in 7 years, in October, we reached the highest rates in 7 years, and at the end of December, we're at the lowest rates for 2018. So it's something you want to keep mindful of all this. I mean, it's you want to be aware of it, but at the same time, as you may not have been here in the beginning of the presentation, we're still talking about low interest rates.
Yeah. And even with Chris Thornburg, who I mentioned to you, again, Beacon Economics, I'd recommend you take a look at his website. He was talking about, the question kept coming up, is there a bubble, right? The recession, every 10 years we have a recession, we are due. Don't we hear these words all the time? And he made such a great response to that. He goes, it's not about the when, it's about the why. Why would we be going into a recession? There's no indication that that is the case, right? Why would we see a real estate bubble, which we're not seeing? So it's a great, just skill, I guess, to have, to be able to talk to your clients, ease their concerns, say the data doesn't support that you are buying into a real estate bubble. And I think you're so well armed to have this information and have people like these three for resource and call them and say, what are your forecasters at Bank of America saying? I mean, these are some of the greatest minds in finance, and forecasting. Same with all of the folks that you all pay attention to. So I think it's really, really important. Any other questions? Starbucks card going once?
Two that came up during discussion that I just didn't raise my hand was, Aaron, reverse mortgage. Do people refi because their equity's higher and they can cash out and get better rates on reverse the same way they do any other?
They don't typically do it for that purpose. Yeah, it's usually just because they are having trouble making the payment, and that's why they would do that. Not so much to cash out. Is that? Do I understand the question correctly? Yeah. Okay. Yeah, that's typically.
The other is earlier you guys were talking about credit, lender credit, seller credit. I was at a signing recently where there was an issue where the credit cannot exceed the closing costs, entire closing costs. Is that correct?
That's correct.
I was going to actually touch on that when we were talking about it. We just got on the topic. So that's really important, actually. So that is something to be mindful of. Seller credits and lender credits cannot exceed the closing costs. If they exceed the closing costs, they can. If they exceed the closing costs, something that your loan officer definitely wants to be mindful of or be ahead of. Because if it does, then it either has to be structured, there can be a buy down of the interest rate, use that cost to use up the credit, or you can do what's called a principal reduction to reduce the amount of the principal of the loan that they're borrowing. But that's something, there's a max on that as well. Like there's only a certain amount. So if you don't want your clients to leave money on the table, or if your loan officer doesn't want to do that, it's something he wants to be ahead of as the process moves along. And as long as you're doing that, then you're not going to have any delays in your closing.
I was surprised that prepaid interest on those types of things were considered closing costs. I thought it would really only refer to actual fees.
Not in the past they weren't, but now they're considered.
Yeah, great. Any other questions? I'm really grateful for all of you making it here through all of the detours. Oh my gosh, and I'm sure we would have had a much bigger house, but I'm so grateful to the three of you. Can we do it again and try to invite the folks back that didn't make it? And thank you so much for being here and for doing this and serving the real estate community. And use these folks. They're terrific. They're wonderful. So thank you very much.